Example 8 illustrates a situation where a resident company becomes a non-resident company. So the first thing I just want to talk about just quickly, just to remind you, so resident becomes a non-resident. Now when it happens to a company, it's the same basic principles that apply. Resident is mostly in the net, non-resident is mostly out of the net. So at this point in time, again, same thing happens. There's a deemed sale at market value. Except for immovable property in South Africa and permanent establishment assets in South Africa. Plus there's one other thing that happens, and that is it's actually over here, sorry, there's a deemed dividend in specie, and it is the market value of shares less contributed tax capital. And then as a non-resident, you obviously deemed purchase at market value. So let's look at this question. XP2I Limited is a company held in equal shares by two brothers who are residents of South Africa. The company was incorporated 10 years ago. During the current year of assessment, the brothers decided to immigrate to Great Britain with their families, and they immigrated on the 1st of August of the current year. As the place of effective management has shifted to Great Britain, you may assume that the company is considered a resident of Great Britain from this date. As the brothers had been planning to move for some time, the company has been steadily selling its assets and renting temporary replacements instead. All of this has been treated appropriately for tax purposes. Because of these disposals, the company had very few assets left on the 1st of August. And the assets on hand were the following. Okay. Business premises, note 1. The business premises represents a shop and a business premises that is situated on. It was purchased 5 years ago and improvements of 300,000 have been made. The business premises will be sold in the future. It is an asset of a permanent establishment. Alright, so this is a permanent establishment in South Africa. So there is no deemed disposal. Note 2. The computer equipment was used by the business as part of its income earning activities. The computer had an original cost of 100,000. The wear and tear deducted under section 11E amounted to 40,000 until the end of the last day of the previous year of assessment, and the wear and tear from the beginning of this year amounted to 7,000. You may assume that this amount is correct for tax purposes. Once the computer became a resident, the computer equipment was no longer used. The computers will be sold along with the business premises in future, and you may assume that the recoupment, if it had to be calculated, would be 12,000 rands. This is also a permanent establishment in South Africa, so there's no deemed disposal. Note 3. Trading stock. The trading stock had a cost of 90,000 and represents items that the company had not been able to sell before it became a non-resident. The trading stock had been on hand at the beginning of the year. Right, so guys, this is not a permanent establishment asset, it's just trading stock, so that will be deemed to have been sold at 90,000 rand. So at a cost of 90,000 and treated as if it was sold for 120,000. So let's just quickly go and see it. There we go, 90,000 deduction for opening stock, sold for 120,000. Again, you'll cover this in more in future. Note 4, furniture. The furniture was used at the business premises, so that's not personal use then. The furniture had a cost of 120,000. The wear and tear calculated until the last day of the previous year was 80,000. The wear and tear from the beginning of the year until immigration was 10,000. And they say the recoupment would be 50,000. Again, guys, assume that this is not with a permanent establishment. I will have to give you a little bit more information there and make that link. So it was treated as if it was sold for 80,000. So I'm just going to show you the furniture. There's the recoupment. There's the amount that's allowed as a deduction in the current year. I've included the way which is calculated in here for those of you guys who want to work through it. The capital gain. Market value less the recoupment. Base cost is the cost, right, less all of the allowances claimed. Because remember, why are we deducting the recoupment and why are we deducting these allowances? You have to deduct it because of paragraph 35.3 tells you all amounts that have already been taxed must be deducted from recoupments. That's at 50,000. And paragraph 23 tells you all amounts which have already been allowed as a deduction which is that 10,000 and that 80,000, so the 90,000 must be deducted from base cost. Right, and then guys, they tell you in note 5, the market value of the equity shares is equal to the total value of the assets, and the contributed tax capital is 60 Rand. Brother 1 has 60% of the company, and brother 2 has 40%. So the market value is 3265, so that is what the dividend is that we are going to be paying. 3265 less the contributed tax capital gives us the deemed dividend in specie. Sorry, it's 60 Rand for brother 1, 40 Rand for brother 2, so 100 Rand, and that times 20% is our dividends tax. So brother 1 gets 60%, brother 2 gets 40% of the dividend. Right, in their hands, this will obviously be exempt from Section 10(1)(k) from their perspective, but the company will be liable for dividends tax because it is a dividend in specie, which we'll also cover in a lot more detail separately.